just read some stuff. Hey, don't you think audit is scary? Like, is someone really going to check everything that you do? Like, I'm scared that I make a mistake and they know it. Well, not everything, but kind of. Wait, seriously? So what is an audit actually is? An audit? Well, it's basically when a professional check a company's financial statement to make sure that they are trustworthy and accurate. So, checking if the company is lying? Not always lying. I mean, they just make sure that there are no errors or fraud in the company's financial statement. Still sounds complicated for me. Think of it like this. When a teacher checks the exam paper of their student, they want to make sure that the answer is correct and it's fair. Okay. That's actually kind of makes sense. But how do they even do that? Like, did they just randomly check the numbers? Like, financial statement is quite so many numbers in it. Like, I'm so confused. Not randomly, there's actually a structured process in it. A process? Okay, now you make me curious. What are the steps in audit? Good questions. I'll explain it to you. Hello everyone, today I'm going to walk you through the most important frameworks in an accounting, the audit process. Now I know some of you might thinking audit is a really complicated topic, but actually it's not. It tells a story where an auditor works really hard to make sure that the company presents their financial statement trustworthy and accurate, and there are no material misstatements. In this video, I will tell you the detail of the steps in audit process. There are 4 phases. The first one is plan and design an audit approach. Phase 2 is perform a test of controls and substantive test of transactions. Phase 3 is perform substantive analytical procedures and test of detailed balances. And the last process is complete the audit and issue an audit report. Each phase contains a very important steps, and I'm going to explain to you every single one of them so that in the end of the video you finally understand why auditor needs to conduct auditing phase one by one. Phase 1. Plan and design an audit approach. Phase 1 is all about preparation. Before an auditor even open a single ledger or even open a single transaction, they must first plan. In fact, in an auditing standard, there is a golden rule. Proper planning prevents poor performance. Phase 1 has 8 key steps that I'm going to explain to you every single of them. Step 1 is accept the client and perform initial audit planning. The very first thing that happens in an audit is that the auditing firms decide whether to accept the client or not. This might sound simple, but it is actually a very hard decision and very important for the auditor. The auditor must evaluate: first, is this client worth taking on? Second, does the client have integrity? Third, is there too much risk associated with this engagement? For example, if a company has a history of financial fraud or is currently under an investigation, a reputable audit firm might decide that accepting this client poses too much risk for their own reputation. Once the client accepted, the initial audit planning begins. This is where the auditor decides the timeline and the scope of the audit. These steps is also involved in communicating with the predecessor auditor. If the client had a different auditor from the different law firm before, the new auditor must contact the old ones to understand the previous issue from the previous auditing process. Next is step 2, understanding the client businesses and industry. Once the engagement is underway, the auditor needs to deeply understand the nature of the client businesses and industry in which they operate. Why is this important? Because different industry has different risks, different accounting standards, and different business practices. During these steps, auditors will first study the company's organizational structure. The second one, review its products and services. The third one, understand the supply chain and the major customers. The fourth one, learn about the regulatory environment. And the fifth one, study about the economic conditions of the company. These steps also involve in understanding the related parties. Companies or individuals that are related to the customer and might be related to the transactions that need to be checked. Step 3 is perform preliminary analytical procedures. At this point, auditor haven't dug deep into the details yet because the auditor needs to make a high analytical data about the company's financial condition. They compare the current numbers with the prior years, look for trends, and calculate the ratios. These procedures help the auditor to analyzing the areas that are still undetected and unexpected. The goal of doing the analytical procedures in these steps is to develop a sense of where the risk might lie in the audit process. Step 4 is set preliminary judgments of materiality and performance materiality. Is set preliminary judgments of materiality and performance materiality. These steps introduce one of the most important concepts in auditing, materiality. So, what is materiality? Materiality refers to a significant misstatements in the financial statement. If an error is big enough to change the decisions of the financial statement users like investor and creditor, then it is considered as material. Auditor don't have to find every single error because it is inefficient and impractical. Instead, they focus on errors that are material, meaning that it is significant enough to change the decisions. Here's how it works. Auditors set a materiality threshold. For example, they might decide that any misstatements that are greater than 5% of net income are material. So anything that lower than 5% doesn't need any intensive check. So auditors can skip to the important part that are bigger than 5%. Next, we have the performance materiality. It means a smaller limits that the auditor use while doing their work. It works like a safety cushion, even if there is many small mistakes, and when they combine, it's not big enough to change the decisions, so it stays immaterial because it doesn't really change the decisions of the financial users. Step 5. Identify significant risk due to error or fraud. Identify significant risk due to error or fraud. Now, the auditor asks a very important question. What are the greatest risks of misstatement that can find in the financial statement? And are those risks due to fraud or error or due to honest error? This step is required by the auditing standard and it involves a deep evaluation of what can go wrong. Risks due to error are unintentional. Maybe the accounting team made a calculation mistake or applied the wrong accounting standard. Risks due to fraud are intentional misrepresentations. Management deliberately overstate revenue to meet investor expectations. All of these are potential fraud risk factors, and auditing standards require auditors to pay special attention to them. One area that auditors are always required to assess for fraud risk is revenue recognition, because manipulating revenue is one of the most common forms of financial fraud. Step 6. Assess inherent risk. After identifying what could go wrong, auditor now formally assessing inherent risk. Inherent risk is the natural susceptibility of a financial statement area to material misstatement, assuming there are no internal controls in place. In other words, how risky is the account or transaction type simply by its own nature. Some accounts are inherently riskier than the others. For example, cash. Cash is highly vulnerable to theft, high inherent risk. And then we have estimate and judgment, like allowance for doubtful accounts, are inherently risky because they depend on management's assumptions. And we have inventory that can be misvalued, especially in industries where prices fluctuate rapidly. On the other hand, something like prepaid rent, which is typically straightforward, would have relatively low inherent risk. By assessing inherent risk, the auditor decides where to focus their attention and resources during the audit. Step 7. Understand the internal control and assess control risk. Internal controls are the policies, procedures, and systems that a company has in place to prevent and detect errors and fraud. Examples include requiring two approvals before a large payment is made, reconciling bank statements every month, limiting who has access to sensitive financial data, conducting periodic inventory counts, and then we have the control risk. It is a risk that the company's internal controls will fail to prevent or detect a material misstatement. The auditor's job here is to understand how the client's internal control system works and then evaluate how effective those controls actually are. If the auditor concludes that the internal controls are strong and reliable, they can rely on those controls and reduce the amount of detailed testing they need to do. This is efficient and cost-effective. But if the controls are weak or poorly designed, the auditor must perform more detailed testing themselves to compensate. The last step is finalize the overall audit strategy and audit plan. With all the information gathered in the previous 7 steps, the auditor now creates a formal audit plan, a comprehensive document that outlines exactly how the audit will be conducted. The audit plan includes, first, which areas of the financial statement will be audited. The second one, what type of the audit performance that will be performed. The third one, how much evidence that needs to be gathered on. And the last one is the timeline and the guideline. Once this plan is finalized, the audit teams move to active execution, which brings us to phase 2. Phase 2. Perform tests of controls and substantive tests of transactions. Phase 2 is where the auditors begins to the actual testing work. Phase 2 has an interesting part because it starts with the key decision. The key decision says that, do we have a plan to reduce assessed level of control risk? In simpler terms, the auditor asks, is the internal control of the company is good enough so that we can rely on them? If the answer is yes, the auditor proceeds to test those controls. But if the answer is no, the auditor skips directly to the substantive testing. Because relying on an internal controls that are not safe are very inefficient. Next, we will discuss first about the test of controls if the answer is yes. If the auditors finally conclude that the internal controls appear strong and reliable, they must first verify that those controls are working as intended. This is done through test of controls. The example of test of controls are, first, re-performance. The auditor independently redoes the control procedures to see that if they get the same result. The second one is inspection. The auditor examines the document to see if the evidence they got is the same and reliable. The third one is observation. So the auditor watching the employee doing the control activities real time. And the last one is inquiry. So the auditor asking the employee how the controls work and whether they follow the following regulations. If the test of control shows that the controls are working effectively, the auditor can lower their assessment risk, and this reduces how much testing that they need to do. Next, we have the next step, which is using the substantive test of transactions. Whether or not the test of controls were performed, the auditor always performs substantive tests of transactions. These are the detailed tests that examine directly the amounts or the transactions. The goal here is to determine whether transactions are properly recorded in the financial statements. Substantive tests of transactions usually focus on key financial statements assertions like occurrence, completeness, accuracy, cut-off, and classification. The last step is assess likelihood in misstatement of financial statements. After completing the test of controls and the substantive test of transactions, the auditor steps back and evaluates how likely is it that there are material misstatements in the financial statements. This assessment combines the inherent risks, control risk, and the result of the testing so far. It will determine how much additional work needed in phase 3. Next, we're going to talk about phase 3. Perform substantive analytical procedures and test of detailed balances. Phase 3 is the deepest and most detailed phase in audit. This is where auditors get into the numbers. They examine account balances, verifying assets, confirming liabilities, and making sure the financial statements reflect the economic reality. Depending on the assessed likelihood of the misstatements, low, medium, high, or unknown, the auditor chooses their approach. If the risk assessment is low, the auditors can heavily rely on substantive analytical procedures. These are more sophisticated than the preliminary analytical procedure in phase 1 because the auditor, first, develop precise expectations on what account balances should be. The second one compares those expectations to the actual recorded balances. The third one investigates any significant differences. Common analytical techniques include: first, ratio analysis. They comparing the current years with the prior years and also the industry benchmark. The second one, trend analysis. They look at how the numbers change over time. The third one, regression analysis, using statistical models to predict expected values. When the risk is higher, the auditor performs tests of key items, meaning they especially target the largest and most significant numbers in the account balance. For example, in account receivables, the auditor might specifically request from the company's 10 largest customers because those accounts represent the most material amounts. This is a targeted, efficient approach rather than testing everything equally. The auditor focuses their energy where the potential misstatements can be most significant. When the risk is high or unknown, the auditor must perform extensive tests of detail of balances, the most thorough form of auditing testing. Tests of detail of balances examine individual items within account balances and verify them with external objective evidence. Examples of tests of details for common accounts are: first, cash. Obtain bank confirmations directly from the bank, perform bank reconciliation procedures, test for any unusual or large cash transfers near year-end, and we have account receivable, like send confirmation letters for customers asking them to verify the amount owed, and then examine the subsequent collections, or did the customers actually pay after year-end, and then review the aging schedule to assess collectability. And we have inventory. Attend the client's physical inventory count, select items to count and compare to records, test for absolute or slow-moving inventory, and verify inventory valuation. Is it recorded at cost or net realizable value, whichever is lower? And we have fixed assets, like inspect major assets physically, agree purchases to invoice and contracts, and verify depreciation calculations. For account payable, search for unrecorded liabilities, check disbursement made after year-end, send confirmations to major supplies, and review vendor statements. Phase 4. Complete the audit and issue an audit report. Phase 4 is the final chapter of the audit process. This is where everything comes together. All the evidence is compiled, all the conclusions are formed, and the auditor communicates their findings to the world. The first step is perform an additional test for presentations and disclosures. Before concluding, the auditor must verify that the presentations and disclosures in the financial statements are complete and appropriate. Financial statements don't just contain numbers, they also contain notes and disclosures that explain the accounting policies, provide details on significant transactions, and give users important context for interpreting the numbers. Step 2. Accumulate final evidence. At this stage, the auditor reviews all the audit work, perform and accumulates final evidence to support their opinion. This includes: first, subsequent events review, checking if anything significant happened between the balance sheet date and the date of the audit report. For example, if the company had a major lawsuit filed against them after year-end, that might need to be disclosed. 2. Going concern assessment, evaluating whether there is a substantial doubt about the company's ability to continue as a going concern. For example, will the company survive for at least the next 12 months? The third one, final analytical procedures, a last overall review of the financial statements to make sure nothing looks out of place. The last one, a formal letter from management confirming that they have provided all relevant information to the auditors and that the financial statements are their responsibility. Think of this step as the auditor doing a final quality check before reaching their conclusion. The third step is evaluate results. With all the evidence in hand, the auditor now evaluates the overall results of the audit. The key questions is, do the financial statements in all material respects present fairly the financial positions and results of operations of the company? To answer this, the auditor considers the total amount of the non-misstatements found during testing, the estimated amount of likely misstatements, and together, these misstatements exceed the materiality threshold or not. If the misstatements are below materiality, and if no other serious issues were found, the auditor can issue a clean opinion. If the misstatements are above materiality, or if the client refuses to correct them, the auditor must consider modifying their opinion. The first step is issue the audit report. This is moment of the truth. The audit report. The audit report is the auditor's official public communications to shareholders, investors, creditors, and other users of the financial statement. It is one of the most important documents in business finance. There are several types of audit opinions an auditor can issue: unmodified or clean opinion. This is best possible outcome. The auditor is saying, in our opinion, the financial statements present fairly in all material respects the financial positions of the company. This gives users confidence in the financial statements. The second one, qualified opinion. The auditor issues this when there is a material but not pervasive misstatements or limitation. It essentially says the financial statements are fairly presented, except for the specific issue. The third one, adverse opinion. This is the most severe opinion. The auditor concludes that the financial statements are materially and pervasively misstated and do not present a fair view. This is extremely rare but very serious. And the fourth one, disclaimer of opinion. The auditor is unable to express an opinion at all, usually because there are significant scope limitations that prevent the auditor from gathering sufficient evidence. The audit report is signed, dated, and officially published, and for publicly listed companies, it is available for everyone to read. And the last step, communicate with the audit committee and management. The final step is communication. After the report is issued, the auditors formally communicate their findings to the audit committee, a subcommittee of the board of directors responsible for overseeing financial reporting and the audit process. The auditor will share any significant deficiencies or material weaknesses in internal controls, or any significant accounting estimates, and maybe disagreements with the management. The auditor's views on the quality of the company's accounting policies, and also the management. The auditor will provide a management letter that includes recommendations for improving internal controls and accounting practices. While this is separate from the audit report itself, it is extremely valuable because it helps the company strengthen its processes going forward. These communications complete the audit cycle, and then the whole process begins again for the next year.